Have you ever wondered how the ultra wealthy investor money, people like Oprah and Jay-Z, Beyonce, and so many more, and get 1,000+% return? In this video, I'd like to talk to you about equity crowdfunding, these pre-IPO opportunities that the ultra rich invest in and is now available to the average Jane and Joe like me and you. Hey friends, my name is Jay. I'm an investor based out of South Florida. I actually work right now as the head of marketing for an equity crowdfunding platform, and we only focus on space companies and happen to be the largest community of space investors. In this video, I'd like to walk you through what is equity crowdfunding and more importantly, how you can capitalize on it. At the end of the video, I'd like to walk you through some of these offerings and we'll make a couple of equity purchases together. The first successful crowdfunding campaign was actually in 1997 by a British rock band called Elon. They decided that they wanted to go on tour, but they didn't have the money to do so. So a bunch of their fans essentially pitched in and funded their tour here to the US, and thus starting an entire industry called crowdfunding. The US government didn't allow just anyone to invest. You essentially needed to have a net worth of over $1 million or annual income above $200,000. But that actually changed back with the Jobs Act in 2012. The Jobs Act made it way easier for businesses to acquire funding and gave essentially everybody an opportunity to invest in these startup businesses. With these opportunities, a ton of websites popped up. These websites act as brokers where they connect the businesses that are in need of funding and the investors who would like to invest in these opportunities. From there, crowdfunding actually took a life of its own. And this year alone, there has been more than $1 billion invested in equity crowdfunding, with the market on track to grow by 30 to 40% over the next 3 years. Willamette University did a research over 15 years, and it studied 1,200 of these equity crowdfunding investments. The results showed an average of 160% return over any 4-year period. That is a lot higher than investing in the stock market. So let's talk about some of these platforms. They're registered with FINRA, and they are essentially allowed by the US government to raise these funds on behalf of these businesses. A lot of these businesses that need to do the raises, they need the money for either a prototype, for demo services, or essentially to get off the ground. But sometimes they actually just do the crowdfunding campaign just for brand awareness. If they have a service or a product and they want to get in front of their actual consumer base, one of the ways that they can do that and find people that have money is to get in front of these investors, which these platforms will provide. The platforms take both a share of cash and equity. Each platform has their own structure on how they get paid. Most likely it's a mixture of both. So I want to bring to your attention a couple of platforms that I've used and some of the ones we'll use to buy some equity at the end of the video. One of my favorite ones is called Start Engine, and I like Start Engine just because of the sheer volume of deals that they have, right? They're gonna give you a ton of different opportunities, different types, different industries, different sectors. Start Engine is ranked as the #1 portal for deal flow. Keep in mind, just because they offer a ton of deals doesn't mean all of them are equal opportunity. By that, I mean like you investing in one of the companies doesn't mean you're gonna get the same return as you investing in one of the other companies. The sheer volume that they do, in my at least experience, speaks to the quality of the deals that they're bringing onto the platform as well. So that's something to keep in mind. You have additional companies like Republic and WeFunder that will offer a different alternative. Republic is known a little bit for their scrutiny before you can raise on the platform, so they do a bit more due diligence than the rest. And you have something like WeFunder, which doesn't actually have a specific sector, like Start Engine, which is just technology. WeFunder will allow anybody to raise on any business, any industry, any sector on their platform. Celebrities have been doing this for quite some time. For example, Ashton Kutcher, who has more than 54 equity crowdfunding investments, most recently an investment app called Titan, which have been showing me ads like crazy. I already signed up. Please leave me alone. And he also has millions of dollars invested in all the others. Oprah has more than $500 million invested. And even Jay-Z, his biggest early stage startup investment was, well, in Beyonce. I'm kidding, but he did invest in Therabody, which is that massage gun I'm sure you've seen ads for everywhere. Just to give you some additional perspective, Mike Markula was the first outside investor in Apple, and he bought $250,000 of shares back in 1977. A few years later, the company went public and issued him some shares, and he made a whopping $203 million. At the time of this recording, there are a ton of companies doing some really interesting things. Here are a couple ideas on just things that you can invest in. You can invest in alcoholic beverages, real estate, both in physical and metaverse, and even space computing. I'm sure you get the idea by now. So how much can you actually invest? Because if you are, a multimillionaire, you can't actually put all your investments into equity crowdfunding. The SEC limits how much a person can invest on a yearly basis based on their income and net worth. Here's a chart outlining how much you would be able to invest. So if your annual income is $30,000 and your net worth roughly $100,000, well, you would be able on a yearly basis to invest $2,200. If you're a multimillionaire and your annual income is 1.2 million and your net worth is around 2 million, well, you can put in $107,000 into equity crowdfunding deals. But how do you actually pick the right deal to invest in? I like to cover a couple of things that I look for when I'm going to buy some equity in a company. The first one is the management. One of the most common reasons that startups fail is because of the management. The management has never gone through an acquisition before. They are not familiar with the industry, familiar with the objectives, the competitor, the landscape, etc. When you're buying a company, if they don't have a product yet or even a prototype, the only thing you're really buying is the founder and the co-founder's vision. So if they are not the right people to execute that mission or the goal or whatever the business strategy is, well, your investment is not going to go anywhere. $1 billion idea is worthless if the entrepreneurs behind it don't have the grit and the strategy and essentially the endurance to see it through. The other thing I like to look at is the product, right? What stage is their product at? Are they just drawing this up on an iPad and essentially they need to build a prototype, or do they have a prototype, something that's working, something that's been tested, and something that consumers have already bought and have worked with in the past? I also like to look at unique advantages. So I think that everybody has a unique advantage, and I'll give you my use case and then talk about it in a more general term. My general use case is I'm very good at acquisition. I've been doing that for the past 10 years. So whenever I'm looking to invest in a deal, I want to know what are their acquisition strategies? How are they going to bring in customers? How are they going to bring in recurring revenue? How do they make money? And obviously, to make money, you need to have a way that you're bringing in these customers. So I go through their Facebook ad accounts and I go through their Instagram ads and I look at, what's the cost per acquisition? What is your retention rate like? And that is my unique advantage because not everybody in the market has deep level of understanding in this as I do. If you're a musician or an esthetician and you've worked with beauty products your entire life, well, there are a lot of CBD brands and beauty brands, hair products, nail products. You essentially can look at the label and what is the composition of these products? What ingredients are they using? Maybe you know of a farm in somewhere that has a shortage of these products. And if it's the main product and their ingredients, then they're not going to be able to produce it anytime soon. The cost of these. So again, just take a step back, look at what are you essentially an expert in, and then find these companies that you can apply that expertise to before you invest. The other thing is I always reach out to the founders and I say, hey, look, this is my area of expertise. Do you need help in it? And I offer my expertise because at this point, I'm an equity investor into the company. So I want to make sure that they have all the tools and resources available to succeed. I will do a full audit of the business, of the ads. I want to look at where they're spending, what are they targeting. And if there's anything I could do to make the company better, it increases the odds of my investment being successful. Another thing to make sure you consider is that your investment is going to be illiquid for a long time. The investment term for something like this is typically 10 years. So someone could buy out the business or the product or the patents way earlier, but you just can't expect it, right? That money is going to be tied up for a very long time. So not only can you lose all of it because it's a high risk investment, high reward, but at the same time, if everything is progressing well, the company is developing and progressing through the stages, your money is going to be tied up. The other risk that you should consider is the risk of dilution. Now, this doesn't typically mean that you're going to essentially have less money invested into the company or that the value of the money you invested is going to go down. But it is possible that as the company progresses and does Series B and A, etc., bridge rounds, you could own less and less and less of the company. It doesn't necessarily mean that your percentage, it has less value, because if the company is progressing and doing more rounds, more investors are coming in, the valuation of the company is climbing, meaning that the initial dollars you put in are worth more, although you own less and less of the company. It's just something to keep in mind. Some companies do dilute very heavily. If you do get an email or a notification, which they're obliged to let you know, keep that in mind, read through the docs and understand what's going on and what they're doing.
Hey friends, so I am here on Republic and I want to pick one of these investments that I would like to invest in with you. I have looked around a little bit. There's really nothing I'm interested in other than this one. and it's a company called King's Crowd. And based on my affiliation, Space Ventures, it's the wrong link, they actually have rated some of our deals. So what they do is they take, these private markets and provide additional insights to investors. So they're community-based of investors that, want additional information. So kind of think of them as like Morningstar. I think they mentioned it here too. I saw it in one of the sentences. Yeah, here it is. Like Bloomberg, and help you make an informed investment. So because I worked with them, I know these guys. I went through, all of their deal terms. They've already raised a decent amount, and they have a pretty crazy growth. So 20 times in 2020. And I also know for a fact, because I work in the equity crowdfunding space, that equity crowdfunding continues to boom. So I'm going to make an investment. I already have my account created, and it's going to ask me some questions. Are you employed? Yes. Do you have any dependents? Yes. 2, me and my wife, or my wife and my daughter. I am not affiliated. Understand? Yes, this is all normal. I do have some experience, investable assets. I'm looking to invest less than 5%. Yes. What happens if I hit no? No, because it doesn't matter. I don't really think this matters. I mean, if you drop this to like 200, well, it's got to be 1,000. What happens if we do this? I want to see if it's just going to kick me out, because a minimum investment is 1,000. Payments are processed immediately. So I'm going to go in here, put 1,000. Now, what I would like to actually use is my IRA, and I have an Alto account. I invest in these equity crowdfunding deals through a self-directed IRA. Once you hook up either your card or bank, wire, or your IRA, then you would essentially accept the terms and confirm investment, and then you're pretty much done. So that's how I would go about investing, and that's how you kind of go through the platform.
All right, guys, that's everything. If you enjoyed this video, consider liking and subscribing to the channel, where I post a lot more content just like this. Enjoy the rest of your day.